In our previous video, we explored Samuel Benner's remarkable market cycle predictions from 1884 and how his cycles have shown statistical significance over 150 years. Today, we're diving deeper into what this actually means for your investment portfolio right now. How do you practically apply these century-old insights to modern investing? And more importantly, where should you position your money for the next decade? Let's start with where we are right now. According to the Benner cycle, we're currently in what's called a minor 9-year phase. It began in 2024. This phase is divided into two distinct periods, 2024 to 2026. Favorable years. These are the years when markets historically outperform their long-term averages. 2027 to 2032. Unfavorable years. These are periods of increased volatility and below-average returns. Now, let's look at the numbers. When we analyze market data from 1793 to 2023, here's what we find. During favorable years, the market averaged 11.70% annual returns. During unfavorable years, returns dropped to 6.57% annually. Most importantly, 74.2% of all negative market years occurred during unfavorable periods, and the cycle appears to be holding true. The S&P 500 has delivered 15.12% returns year-to-date, significantly above the historical average and exactly what we'd expect from a favorable year. So what does this mean for your portfolio strategy? Let's break it down by time periods, starting with the current favorable phase. For 2024 to 2026, the aggressive phase. Your portfolio should be positioned to capture the upside momentum. Here's a framework to consider. 70 to 80% equities. Focus on large-cap growth stocks, technology, and sectors that benefit from economic expansion. 15 to 20% bonds. Maintain some stability, but don't over-allocate to fixed income during growth periods. 5 to 10% cash and alternatives. Keep some dry powder, but don't sit on too much cash during favorable years. Within your equity allocation, consider overweighting technology and innovation, AI, cloud computing, renewable energy, consumer discretionary. Companies that benefit from economic optimism, financial services, banks, and investment firms typically perform well during favorable cycles. Growth-oriented REITs, real estate investment trusts focused on expansion. For 2027 to 2032, the defensive phase. Your strategy should shift toward capital preservation and opportunistic buying. 50 to 60% equities. Reduce exposure, but don't abandon stocks entirely. 30 to 35% bonds and fixed income. Increase allocation to government bonds, high-grade corporates. 10 to 15% cash. Build a larger cash position for opportunities during market downturns. Within your reduced equity allocation, focus on dividend-paying stocks. Companies with strong cash flows and consistent payouts. Defensive sectors, utilities, consumer staples, healthcare, value stocks, companies trading below intrinsic value, international diversification, reduce home country bias. Let's look at how this would have worked in practice. Take the period from 2017 to 2023. These were classified as unfavorable years according to the Benner cycle. Despite being unfavorable, the market still gained over 100% during this period. This illustrates a crucial point. Unfavorable doesn't mean negative returns. It means higher volatility and increased risk of corrections. During this period, we saw the COVID-19 crash of 2020, negative 34% in 5 weeks. The 2022 bear market, negative 25% for the S&P 500, multiple 10% plus corrections. Investors who maintained defensive positioning weathered these storms better and had cash to buy during the lows. The key lesson? The Benner cycle isn't about market timing. It's about risk management and strategic positioning. It helps you adjust your risk tolerance based on historical patterns. Prepare mentally for different market environments. Make more informed allocation decisions. Avoid emotional investing during volatile periods. Before we conclude, let's address the critical limitations and warnings about using the Benner cycle. First, past performance never guarantees future results. The Benner cycle has shown statistical significance, but markets can always surprise us. Second, This is a framework, not a crystal ball. Use it to inform your strategy, not to make all-or-nothing bets. Third, your personal financial situation matters more than any cycle. Never invest money you can't afford to lose, regardless of what any model suggests. Fourth, diversification and risk management always come first. The Benner cycle should complement, not replace fundamental investment principles. Your action items for this week? Assess your current allocation. Are you positioned for the favorable years ahead? Create a transition plan for 2027. Start thinking about how you'll shift to defensive positioning. Build your opportunity fund. Even during favorable years, keep some cash for unexpected opportunities. Educate yourself further. The Benner cycle is just one tool in a comprehensive investment toolkit. If this analysis helped clarify your investment strategy, hit that like button and subscribe for more deep dive market analysis. Comment below with your biggest takeaway. Are you planning to adjust your portfolio based on the Benner cycle? In the next video, we'll explore how to combine the Benner cycle with other market timing indicators for even more robust investment strategies. Until then, invest wisely, stay disciplined, and remember, time in the market beats timing the market. But understanding cycles can give you an edge. Thanks for watching.